Welcome to the MUFG Global Markets Podcast. I'm your host, Ellen Tang, and I'm joined by Glenn Schultz today, the head of our agency mortgage prepayment modeling and strategy for MUFG. Today is Wednesday, August 10th, and thank you again for joining us this month, Glenn. It's nice to speak to you.
Hi, Ellen. It's my pleasure. Thank you for inviting me today.
So July, the remit data came out on Thursday, August 4th, and then aggregate prepayment measures by, using Fannie 30-year mortgages declined 17% on a month-over-month basis, down to 7.8 CPR. So kind of where we are now in the mortgage landscape is that the 30-year mortgage rate is over 5%, the housing market is cooling, and the Federal Reserve has signaled it will continue raising the short-term interest rate. We're likely to hit the Fed Reserve MBS purchase cap this month. So with all that said, what are your thoughts with respect to this month's prepayment report and the overall agency mortgage market?
Sure. First, let me discuss the driving mortgage rate as it's viewed through our prepayment model. So the driving mortgage rate went up 6 basis points in July, and that's because we look at the past 3 months of mortgage rates in the model. So April dropped out of the series and then was replaced by July's higher rate. So even though sort of the mortgage rate fell in July, still higher than it was in April, and as a result, the driving mortgage rate increased about 6 basis points in July. And given where we're at on the current 30-year mortgage rate, the May is going to drop out another 5.10 to be replaced by a 5. So, I expect that we'll probably see something around, 3 to 5 basis points or so, depending on where rates go, increase in the mortgage rate that's going through our model. So it's going to have a little impact, not a big impact going forward. But with that as a backdrop, what we did see was the July turnover cohort, which remained the 4.5 of 2019. So that's the same turnover cohort we identified last month. Makes sense. We haven't had that much of a change in sort of rates to move that cohort. And that reported a little over a 19 CPR. So that was down 12% on a month-over-month basis from July. So what we are beginning to see now is that turnover is beginning to slow. And that's in the moderately seasoned cohorts, the sort of 31 to 60 WALA that we were talking about sort of last month. And then one of the things that we were looking at, and we put out a client note, I think it was on maybe the 3rd of August, that we were looking at sort of that moderately seasoned S curve with an expectation that would flatten, and that was going to give us a more of an indication of burnout in that cohort, and that was going to lead us to some changes in terms of how we view the coupon stack and the coupons. And we did see that flattening of the S curve as well in the moderately seasoned. So really right now, the story is burnout is fully manifested across the coupon stack and the new productions, or the season productions, I'm sorry. And turnover is beginning to slow. So we're really kind of exiting the final throes of the refi wave, if you will, that was induced by the pandemic.
Got it. So now that we are finally seeing burnout in the moderately seasoned cohorts, what are the implications of this, if any, of the burnout in this cohort?
Yeah, so this cohort is, and we've talked about this a lot, is really been the favorite of the originators. Well, this is where the borrowers were. It's where they had, streamlined refinancing and all those types of things, and I think they pretty much run through that cohort. So it looks to me like it's played out. And so what we were beginning to think about is, if the refinance risk moves from the moderately seasoned cohort, does it go anywhere at all, right? And it was actually Russ Middleton, his notes that got me thinking about this more and more. And when I think it through, I think what happens is I come to this conclusion that there is this sort of underappreciated refi risk in the new production cohorts, right? Particularly the 4 and the 4.5s. And so this was one of the reasons why we were looking at the moderately seasoned cohort, because if that cohort becomes played out and originators want to maintain, their origination volume, then they're going to have to, in my opinion, look towards the new production cohorts, the 30 WALA and lower. Those are eligible for streamlined refi. They're at a slightly higher rate. And so we think that what will happen is that originators will turn their focus to these new production cohorts, particularly in the 4.5 and higher coupons.
Understood. On last month's podcast, you were arguing the mortgage basis. You represented a good entry point for agency mortgages at the start of July, and the basis has come in substantially since then. So what are your current thoughts on the basis at current valuations?
Yeah, well, I checked my basis model just before the podcast, and in my opinion, we're witnessing a confirmation of our old normal basis thesis. So that is the trading range of the mortgage basis will revert to the pre-financial crisis trading range between 100 basis points and 140 basis points, and as wide as, say, 180 to 200 basis points in a liquidity stress scenario. Our view at the time that we had written our client note on the old normal was confirmation of the old normal would be the market trading the range that we predicted. So at this point, the market has mostly completed the cycle from high of 147 in early June down to 111 basis points. So now when you look at the basis from a technical perspective, the weekly MACD is neutral to modestly overbought, and the support is around 105 basis points. And the monthly MACD is oversold with trendline support at 100 basis points. So based on our thesis of the old normal, there's not much in terms of further spread tightening potential in the agency MBS market.
So while we are on this subject, Glenn, is there anything else that you consider aside from the technical analysis when you form your basis view?
Yeah, there is. Actually, I tend to look at mortgage spreads and relative to the Bloomberg Corporate Bond Index. So a lot of times I'll use the mortgage index spread, and I'll keep the pricing benchmark the same, right? So I'll look at mortgage spreads relative to the 5-10 Treasury blend, and then I look at the corporate bond spread. It's much longer kind of duration than mortgages, but I'll look at that versus the 5-10 split to 5-10 blend as well, because basically that's the same benchmark used for mortgages. So you take the curve out of sort of your spread numbers. So it's kind of curve this number, right, when you talk about your spread. And the Bloomberg Corporate Bond Index is trading at 167 basis points over the 5-10 blend. And you compare that to the Bloomberg Mortgage Index, which is trading about 70 basis points over the 5-10 blend. So, if you think about it from the standpoint of, a mortgage index sell versus a corporate index buy, or a mortgage index buy versus corporate index sell, you curve give 97 basis points. And based on yesterday's close, that was like curve give 97, take out 10 ticks. So, you can look at that and kind of conclude, I think rightly, that MBS are fully valued versus, say their corporate alternatives. Now, it's not really the case that most portfolios, make these dramatic sector swings based on this type of analysis. But, it does influence how MBS investors behave, and how they view relative value within their sector. I don't think this analysis argues so much for a widening of mortgage spreads as, maybe it argues for a tightening of corporate spreads. I don't know. I don't see it arguing, on a widening, but it certainly doesn't support any idea that the mortgage basis can move significantly tighter from here.
Got it. So it does sound like you think mortgages are somewhat fully valued here. Are there any sectors or coupons that you do favor within the space?
Yeah. So yeah, I would say that's a fair assessment, fully valued. And then in terms of coupons and vintages, we had recommended the moderately seasoned 4 through 5 coupons last month on the podcast. That was largely based upon the prepayment outlook that we discussed earlier. And in July's remittance really kind of gave us the slowdown that we were looking for. And I feel like that's really priced in the cohort. So I don't think there's much there now. And so now I favor kind of the new production 3.5. So this moves on to our thesis that, originators have room to sort of bring the mortgage rate down by as much as 50 to 75 basis points between sort of primary mortgage spread and primary secondary spread. Potentially bringing, fours, to the money or at the money, maybe in the money. So I like the 3.5 coupons. If they do that, then new production 3.5 coupons, that would kind of, I think, be the par coupon. And I think that would be where to go. So I like the 3.5s. They'll remain at or near the money. And then in the specified pool sector, I like the new production 4 and 4.5s, right? So obviously in loan balance, new production 4.5s. They do give you the prepayment protection, but they're at this unique inflection point, right? Where given the rates and the prepayment environment, loan balance, new prod 4.5s, provide kind of two-sided protection. Like they're giving you right now extension protection and call protection. So you're getting out of the loan balance sector like everything that it potentially offers, and so that makes payups, I think, attractive, in that sector, given the overall risk reward. So I favor kind of that low loan balance for 4.5.
Got it. So trying to wrap up everything that we spoke about, you think mortgages are fully valued based on your technical view and feel that the old normal basis thesis is proving itself in real time. You've also shifted your focus from 4 to 5% coupon, moderately seasoned, to favor 3.5 new prod coupon. And then you also favor new production loan balance 4 and 4.5. Is that a good way to kind of wrap things up?
Yeah, that's a good way to wrap it up. This is actually a good job because it's a little numerically dense on this podcast. So give you some congratulations on that.
Thanks so much, Glenn. And thank you to everybody for listening to the MUFG Global Markets podcast. You can go ahead, rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts. And please reach out to your MUFG sales rep for any further information. Please check back soon for more insights from the Global Markets research team.